Does it even matter who's in the Oval Office, who the president is, at least when it comes to our investments? I mean, every 4 years we hear the same story, right? This election is going to change everything for the stock market. We have like famous hedge fund investors right now saying if one opponent wins, they're going to pull all their money out of the stock market or they're going to move out of the country. But what if I told you that might be one of the biggest myths in all of finance? In fact, data shows that the market performs different, but maybe the same no matter who's president. Surprising, right? Well, that's just the tip of the iceberg, because under the hood is actually a roadmap that we can follow. It's got a lot of nuance to it. So today I'm going to show you the exact data so you can see the truth behind who and actually what's really controlling the markets and why you're probably worrying about the wrong thing.
With the election getting closer and closer, should you really be worrying about who wins? Does it really affect the stock market, or is this just another myth? Many assume that a change in leadership can make or break their investments. But is it the president's policies driving market shifts, or are there deeper forces at play? Some argue that tax cuts or regulatory changes can sway investor confidence. But how much of the market's movements are actually tied to political actions? In a recent video with veteran entrepreneur and investor, Mark Moss, he reveals his insights and mind-blowing findings about this topic. Make sure to stay until the end of the video to hear Mark Moss as he reveals the truth behind who really is controlling the stock market. As we show you his clips, please give this video a like to show your support, subscribe for your daily dose of crypto news, and let's begin. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Got Trump and Kamala running for the U.S. president. The polls show it's about neck and neck, and a lot of people are concerned on this election. They say that this is the most important election we've ever had, and I might actually agree on that. I know that that's said about almost every election we've had, and that's because each one becomes increasingly more important. There's a lot of reasons why that is the case. The way that they use executive orders. There's a whole lot of things, but this is not about politics. This is about markets. This is about investing and how we're going to make money. And so while there's certainly major differences between Trump and Kamala, in some ways they couldn't be more opposite. In a lot of ways, they're maybe very similar. And certainly regarding who wins, we're going to see massive differences when it comes to social programs, border security, lots of things, censorship, probably the most important topic of our lifetime. But in regards to money, in regards to the U.S. budget, the deficit and money, and then of course the markets and our investments, is it really that different? Let's kind of take a look. Now, the popular belief is that, of course, whoever wins has a massive impact. They elect the head of the Fed. They're going to help direct, the budget of that, set tax policy. Kamala has some pretty aggressive tax policies compared to Trump is the opposite. And so a lot of people think that this influences the market. Like I said, I've seen billionaire hedge fund people are saying they're going to pull the money out of the market, like if Kamala wins, for example. Other people say they'll move out of the country if Trump wins. And so we see it back and forth. However, I like to invest in the market as it is, not as I think it is, not as I think it should be, but as it is. You see, everybody works off of emotion and gut. This is what I feel, and the society has emotionally charged everything. And so today we're way more emotional than we ever have been. But as investors, that's the worst thing that can happen. We want to know the data. We're going to look at the S&P 500, which is the main index. And what we can see from the time Bill Clinton was elected right here, in the first 3 years and 8 months. So from January 1 until September. That's the time frame we're looking at. And what we can see is that while Bill Clinton was here for the first 3 years and 8 months, the market, the S&P 500, went up by 50%, actually 55.9%, about 50%. Keep that number in mind, 55% with Bill Clinton. Well, Bill Clinton got another term. He didn't just run once, he ran again. And what happened the next time? Well, from again, the same period, January 1 through September, we can see that the market went up almost 50%, in this case 43%. So almost 50% again as well. Now, yes, it went up and it went down, and yes, it went up even higher and it came down, but in that same time period, it ended up about 50% up. Pretty interesting. Okay, let's just keep moving on. Let's look at the data. Then we got Obama. Obama came in 2009, we can see here in January, was elected right here. And in the same time period, we see the market going up by 61%, a little over 50%, now 61%. The market's up. Okay, well, that's enough of Obama. We can look at, again, Obama got 2 terms, so we'll look at that. This was the first term, you can see, went up here 61%. The next term, right here, in the same time period, again, 3 years, 8 months, went up again 51%. So it's almost seeming like every president in the first 3 years, a little over 3 years, the market goes up by about 50%. Pretty interesting. Let's keep going. What about Trump? Trump is going to destroy the democracy. He's going to destroy the world, right? Well, or if you like Trump, then he's going to save the world. However, what we can see here is on the same time period, January 1, for the first 3 years and 8 months, the market is up 58%. So it's almost looking like Clinton, Obama, Trump, it doesn't really matter. It's up. What about Biden? Biden's been horrible for the economy, right? He's been horrible for the economy. We've suffered from the highest inflation, the worst unemployment, all of those things. But what happened in the market? Well, for Biden, on the same time, January 1, the same time period, not cherry picking data, 3 years, 8 months, we can see the market was up 53%. Obama, Clinton, Biden, Trump, 3 years, 8 months, the market's up about 50%. Pretty interesting, isn't it? Let's take a look at this. If we zoom out, I don't know how well you'll be able to see this. If we zoom out, this is what it looks like. Each presidential election cycle, guess what? The market just keeps going up. As Lynn Alden says, there's no stopping that train. This is sort of overlapping all the periods together. You can see what this looks like. There is nothing stopping this train.
Mark believes that over the years, regardless of who is president, the stock market has consistently gone up by around 50% during the first 3 years of each term. He points out that during Clinton, Obama, Trump, and even Biden's terms, the S&P 500 rose by roughly the same amount, despite their different political agendas. This contradicts the idea that a specific president's policies directly drive market performance in the way many expect. Now, here are more clips of Mark Moss as he discusses further.
I guess the question is then, if the president doesn't change it, and regardless of who's there, the markets go up, then what's really driving the market? Well, that's a good question to ask. Is it the economic policies of these people? Well, obviously not. They have drastic policies, right? And we have heavy tax policies. We have light tax policies. Trump gave us all kinds of tax breaks. Biden repealed the tax breaks. There's a study that shows that regardless of what the tax rate is, the government can tax 90%, the government can tax 10%. The percentage of taxes collected, the revenue, as a percent of GDP stays about the same. I believe it's 18%. I didn't pull up a stat on this. So regardless if they tax more or they tax less, the percentage of GDP stays about the same. Why is that? Well, because when they tax more, economic activity goes down. So they do get a larger piece, but of a smaller pie. When taxes go down, economic activity goes up. So now they get a smaller piece of a much bigger pie. So regardless of what the tax policy is, that's why it stays about the same. So what's really driving the market? If you watch my channel on a regular basis, then you're familiar with this chart. If you don't, then go ahead and hit that subscribe button right now while you're watching. Okay, now this is the S&P 500. Again, we're using that as the market. Now, what I'm doing here is I'm looking at global liquidity, not US, not the Federal Reserve, not USM2. We're looking at global liquidity because we have to understand that money moves around the world, right? When they print billions of dollars in China, a lot of that money comes to Canada and the US, buying real estate, farmland. You hear about that, right? US companies. So what we can see here is the black line is the S&P 500, the gold line is the amount of liquidity. And what you can see is the S&P 500 is almost a perfect proxy for the increase in the money supply. It moves in almost perfect lockstep. So as there's more money chasing limited goods, supply and demand tells us that the price goes up. We can see it, evidence here's a little bit of another chart. This is USM2, but what this is in the blue line, what we have here is the Fed balance sheet, and in the red line, we have the S&P 500. And again, you can see this moving almost in lockstep. Look at that. This came down, this starts going back up, this starts going back up. Pretty interesting, isn't it? So then the question is, well, if it's not the Fed, if it's not the president, then it has to do with the Fed printing money, but not just the Fed, other central banks, the Bank of Japan, the Bank of China, PBOC, the ECB, the European Central Bank, etc., seem to really be driving this. Now, I like to show this chart too, all the doomers in disbelief. This is the homes. This is the United States National Index, the median home price in the United States. The red line is the home prices. The blue line, again, is the money supply. And what we can see is they move in perfect lockstep. You're not getting rich by your home value going up. It's keeping up with the rate of debasement. Now, this is 2008, and there was certainly a little bubble going on there. Now it's snapped back below, and you can see that home prices are nowhere near all-time highs based in 2008, based off of where the money supply of all the debt in the world has a duration of about 1 to 5 years. Now, on average, that's about every 4 years or so. Every 4 years, the debt has to get rolled over. In order to roll over the debt, they have to create more debt. And you're starting to get the picture, okay? So that creates these liquidity cycles. Now, the interesting thing is that these cycles, these 4-year cycles, also coincide with lots of other things. Now, this is the global liquidity cycle. Obviously, the red line is the hypothetical time frame. The black line is actually the liquidity. And you can see how well this matches up. And you can see right now, the global liquidity is turning up right on par, right on pace to match this global liquidity cycle. Now, what's interesting about this is that 4-year cycle just happens to have started in 2008. So take that forward. 2008, 2012, 2016, 2020, 2024. And that just so happens to overlap with the 4-year business cycle. This is what we see in the ISM. So you can see about every 4 years, this rolls over. And if you're counting with me along, you might also know that this also overlaps with the 4-year presidential cycle, which is exactly what we're in right now. It also just happens to overlap with the 4-year Bitcoin cycle. And so we're seeing all of this thing happen over and over and over. Now, if we want to look at that in regards to global liquidity and understand the markets, we can look at it like this. So we can see we got 3 good years and a down year. We got 3 good years and a down year. We got 3 good years and a down year, and we started October 22. If you go back on my channel, in October of 2022, I made a video, said there is no market crash coming, and here is why. And I made several videos going into early 2023 explaining this. You can see from October 22 to present, we are on another upcycle. So regardless of who the president is, we are on these 4-year cycles, and the presidency cycle just happens to coincide with that. And that's why whoever the president is sort of irrelevant because, again, nothing stops this train.
What about you? What do you think will stop this upward trend in the stock market? Share your thoughts in the comments. If you found this video informative, please give it a thumbs up and subscribe for more important updates and discussions on Bitcoin and the crypto world. Thanks, and see you in the next one. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.